Warm greetings to you, billionaires all over the world. This is another presentation by Sir Jef, Mr. Masechengo, presenting on business finance. So today we want to cover a lot of concepts. We are going to start with our lesson plan, understanding business finance. The first thing that we are expected to do today is to state the 4 requirements for a loan application to be a successful one. Then number 2, we need to move to BA, explain what investors consider before an investment. Then the last part is explain factors considered. We are supposed to explain factors considered in selecting sources of finance. So please take note of command words: state, explain, explain. All right. Then our key terms: collateral. What is a collateral? We need to be in a position to define what is a collateral. We need to define what is gearing, what is ROS, what is dividend cover. I think that's what we are expected to do. So I want you to get your pen and your notebook, and we start. Remember, we are preparing for exams for our A stars, so we can't expect anything less than an A star in this examination. So this is our lesson today. Let's kickstart. So those who are coming across my videos for the first time, remember there is COVID. Let's stay safe, but we need also to plan for our future. COVID is not the end of the day, so we need also to plan online. These are some of my former channels that we use for communication. We use Zoom application. You can contact me using my email. You can contact me using my phone number that is appearing there. So that is that. Then also we need also to move on to the first item that we need to know for today. And let me get my pen so that we can interact. Remember, this must be interactive lesson where we are working together and we discuss. Remember, at the end of the day, I want to give you a past examination paper where I want you to practice. Okay, what are some of the requirements that you are supposed to meet when you apply for a bank loan? What are some of the requirements that you need to meet when you apply for a bank loan? The first requirement that you are expected to meet is you need to produce what we call a cash flow forecast. What is a cash flow forecast? I think those who are coming across my video for the first time, you might have missed this video. A cash flow forecast shows the business cash inflows and the business cash outflows. So that's what we call a cash flow forecast. Is a forecast, is a prediction of the cash inflows, the monies that will get into the business and the monies that will leave your business. So in terms of cash inflows, let's say our inflows. This is our cash, okay, cash in what? Inflows, right? When you're talking of cash inflows, we're talking of, let's say, your cash sales, okay? Cash what? Your cash sales, they represent inflows. Then when talking of outflows, let's say we talk of payments to suppliers. Payment, when we have got payments of rent, okay? When we have got payment of what? Of rent. That's in what? In outflow. So a cash flow forecast is a representation of cash payments and cash receipts. So what you are receiving and what you are paying. So this should be very clear and should be convincing to the bank manager for him or her to approve your loan. Then you're expected also to show what we call a bank, a business plan. You cannot get a loan without a good business plan. So you're expected to show what we call a business plan. A business plan, what is a business plan? I think you can also give your definition, but a business plan is simply a proposal, a business proposal of what your business is all about in terms of your objectives, your business plan, your business strategies, your financial statements are in that. So it's a summary of your business. So you need to produce what we call a business plan that can convince the bank manager to approve a loan. Let's say you want an approval of a loan. Let's say you want a loan of how much? Let's say 20,000. Yeah, the bank manager cannot just give you 20,000 when you don't have sufficient. These are USDs. Remember, a loan of 20,000 USD cannot just be approved without this. So for that loan to be approved, there must be a good business plan, a good business plan, a cash flow forecast statement. Then also there must be an income statement. What is shown in the income statement, I think we've agreed, this is where you find your gross profit. I think I've explained where you find also your net profit. So it will articulate everything in terms of your gross profit and your net profit. Then also you need also to show the bank manager has to check on your gearing. What is gearing? This is the extent to which a company is financed by borrowed funds, right? Gearing is the extent to which a company is financed by what? Borrowed funds. The extent, can you take that note down? Is the extent, okay? Or in simple terms, we're saying is the degree, okay? Is the degree or is the extent to which a company is financed by what you call debt capital. Debt, remember the spelling, debt what? Capital, right? Debt capital, we are saying this is borrowed capital. So we are checking how far are you financed by borrowed capital. That degree, we call it gearing. So a company that is highly geared, it means it is financed mainly with debt capital. Let's say a company has a loan, okay? There's a loan of total loans of the company is equal to, let's say 20,000, right? And the total capital of the business, let's say the total capital is equal to, let's say 10,000, okay? I'm not 20, it means, let's say this is 100,000, okay? The total capital is equal to 20,000 and the loan amongst the capital is equal to how much? Is equal to 100,000. So it means if you want to calculate the gearing ratio in this case is very simple. We say 20,000 over 100,000, we multiply by 100. This is our what? 20%. So the gearing of this company is equal to what? 20%. So this company, the extent to which it is financed by debt capital is 20%. I think that is very clear to you. Then another aspect that we need your loan to be approved. For your loan to be approved, there must be clear information in terms of the use of the loan. What do you want to use this loan of 20,000? You have a loan of how much? $20,000. What do you want to use it for? It must be very clear to the bank manager for your loan to be approved. Okay. Then also there must be a collateral. What is a collateral? This is a security or amount to secure your loan. Your loan should be secured. Let's say you have failed to pay the $20,000. So it means the bank will make a loss. No, the bank should not make a loss. You must promise something. So it's more of a pledge. You must promise something. It must pledge something to the bank that if I fail to repay your 20,000, then it means you are expected to what? To repay maybe in other forms. Let's say you have got a car to cover that. So I think that is very clear, loud and clear. Let's move on to another aspect that I think is very important for you, particularly to investors when they are investing their monies in the business, okay? Okay, let's move on to another aspect that is very important today. We want to check how investors make their decision. How investors make their what? Decision. There are factors that investors will consider when they are making what? They are making their decision. So there are factors that investors they need to consider when they are making what? Decisions. Number one, the investors they check on the future prospects of the business. They check on the what? Future prospects of the business. The future prospects of the business can also be shown by, let's say, a positive future prospect of a business can also be shown by the profits, okay? The chances of the business making profits in the future. What are these chances? So they can also be shown by the profits of the company. So when you're investing in a company, let's say Econet Wireless, okay? Let's use Econet in this case, okay? Econet, the future prospects of Econet can actually be seen by the profits, okay? Then also, if there are positive future prospects, then you are likely to invest in such a business. Then the dividends, these are rewards. Remember, dividends, we agree, these are rewards that you give to investors, okay? Rewards to investors are called what? Dividends. So you need also to check, does Econet pay dividends, okay? If it's not paying dividends, then as an investor, you become hesitant in terms of what? Investing in such a business. Dividend cover, dividend yield, the earnings yield, I think I will explain on another video. Then also you need also to check on how the share price is changing. Let's say the Econet share is trading at 40 cents today. Let's say then you can actually find the share is trading now after, let's say after a month, it's now trading at what? $50. It means you can see that the share price is actually taking an upward what trend. So it means the share price is going up. There is a likely chance that an investor will invest in such a what? In such a company. Then gearing, you also need also to check on the gearing, the extent to which the company is financed by debt capital. If a company is highly geared, then as an investor, I think you put a question mark. Let's say a company is, the gearing of the company is 90%. It shows that the company is financed by 90% of the capital of the business is borrowed. Then you become hesitant as an investor, become hesitant in such a case. Okay, so other factors that you need also to consider, you consider also the profitability of the business in terms of the ROS, return on capital what employed. Remember we said it's net profit over capital employed. You multiply this one by 100. So if you find that the return on capital employed is 40% in company A, and in company B the return on capital employed is 3%, obviously as an investor you go for company what? Company A. Then also the leadership, the composition, the leadership of the company is very important. It must be, the board of directors. Okay, it must be a balanced board. Balanced what? A board of directors. So if we have got an accountant, okay, we have got lawyers, we have got politicians, we have got all these, they are part of the company's leadership. Then it means that's a better leadership. They have got diverse experience in different aspects of life. So it means you are likely to invest in what? Such companies. Okay, so let's move on to another aspect that I want to explain today. Okay, another aspect which I think can also be very helpful as we finish our presentation. Let's move on. I hope you are following. What are the factors that you consider when you are investing in a business? What are the factors that you consider when you are investing in a business? Let me show you this slide. Okay, these are the factors that you consider when you want to not invest, when you are choosing sources of finance. Okay, you are choosing the source of finance. Which factors would you consider when you want to select a source of finance? So I will explain this one. Number one, choosing sources of finance, you need to consider the use of the finance. Or you want to borrow, you want to raise how much? You want to raise 20,000 US dollars. The question is, what do you want to use it? That's the use. Then also, when you want to choose source of finance, you need to consider the amount that is what required, the 20,000. Then also you need to consider the size of the business. The size of what? The business. We have got what we call SMEs. Okay, according to the World Bank, SMEs are firms that employ less than 300 workers, less than 300 what? Workers. Okay, and they raise less than $15 million per annum. Okay, well, these are what we call SMEs. These are small firms. So if you're a small firm, we can't find you, maybe let's say you want to raise, let's say you want to borrow, let's say $1 billion. Doesn't make sense, right? So you need also to consider the size of your business. Very critical in a choice of finance. Also, you need also to consider what we call the risk associated with the source of finance. We've got what we call chimbazo. Okay, chimbazo in Zimbabwe, right? In Zimbabwe, what they do is when you, let's say you have borrowed $20, you fail to pay, they want it as $40. You fail to pay this $40, they want it as $80. You fail to pay this one, they want it as $160. It means there is a lot of risk that is associated with this source of what? Finance. So you need also to consider the risk that is associated with that. If the risk is very high, then it means it becomes what? Very questionable. The gearing of the company, when you are choosing a source of finance, let's say our company, our total capital, we said it was let's say 10,000, and the loans of the company is, let's say there are 90,000. Okay, you can see actually that the company is highly geared. You cannot go and then borrow again. Okay, let's say you borrow another 10,000. Okay, it means this company is actually technically it's owned by outsiders. So you need also to consider the gearing. We said gearing is the extent to which a company is financed by debt capital. That's very important. Then also what you need also to check is the repayment period. Okay, repayment period. Let's say you want to finance what we call capex. Okay, capital expenditure. It's a capex. Capital expenditure. Let's say you want to construct a dam. Okay, when you want to construct a dam, you want to construct a what? A dam. Let's say a dam, it will need maybe, let's say, 5 years to complete the construction. Then you arrange for a loan that is to be paid, let's say, in less than, let's say, in 12 months. It doesn't make sense, right? You finish the construction of a dam in 5 years, but you are arranging for a loan that is repaid in what? In 12 months. That doesn't make sense, right? So you need also to consider the repayment what? Period. So in this case, you are doing a capital expenditure. Usually it's financed by long-term sources of finance. So you must go for loans, and loans that are long-term. Then the desire to retain what? Control. It's also very critical, the desire to retain control. Let's say we have got what we call sole traders. Okay, sole traders, these are usually, they have got sole ownership of the business. They are their own what? Bosses, okay, in the business. But if you get into a partnership, what happens? If you get into a partnership, it means they will be sharing of what? They will be sharing of what? Of profits. So it means you need also to check on your desire to control the business. If you desire to control your business, you cannot go for a partnership. Okay. If you desire to control the business, you cannot go for shares, because you actually dilute the ownership of your business. So it's very important to consider all these factors before you choose, you select any source of finance. So I think that is very loud and clear. Okay, let's move on to another aspect that we want to cover as we conclude our lesson. Okay, sources of finance. I think this is very clear. I've covered this aspect very well, but maybe as a matter of recapping, there are in short-term sources of finance, there are long-term sources of finance. Okay, we will discuss this one in detail, but we've got what we call a bank overdraft. Maybe let me just clarify to my friends. I know they are my good friends who may have missed this one. So let me try to clarify for you. A bank overdraft is very simple. Let's say your bank, your current balance is 10 million. You can actually arrange with your manager to withdraw how much? 50 million. Okay. So it means you have overdrawn your overdraft. In this case, you've overdrawn your bank amount account with how much? 50 minus what? 10. That will give you 40. That's in overdraft. You ask for your bank to give you more than what you have. Okay. Let's move on to debt factoring. Let's say you have a customer that is owing 10 million, and this customer is refusing to pay. This customer is refusing to pay, or maybe you've got challenges, technical, administrative problems with what? Collecting debtors or debts. What you do is you sell, okay? You sell this customer to another firm. Let's say you sell this customer to another firm, a company X, okay, XPVT. You sell this one, let's say at what? At this 10 million, you say at 9 million. So debt factoring is a matter of selling your debtors at a discount. Okay, you can see that we have sold the debtors in this case at a less than the nominal value. So it means this is what we call debt factoring. It's selling our customers to a factoring company at a discount. Okay, it has disadvantages and advantages. Let's say you don't have the 10 million in this case, trade credit. You just go and buy the goods on credit. Leasing, I think you need to also to take this one as your part of your homework. What is leasing? What is hire purchase? Rights issue, and so on. I think that's your homework that I want you to research on long-term sources of long-term finances. Okay, I think we are almost completing, but we cannot complete without giving you a task. I want to give you a task which I want you to attempt. Okay, let me finish. This is a question that I have adapted from Cambridge. So please, can you attempt this question? After attempting this question, so what I want you to do for the meantime, you pause the video for the meantime. Then after you are done with answering this question, you check on the answer that follows. Okay, then that is the answer for you. So I want you to see this answer that will also help you. All right, this is the answer from Cambridge. So please remember, when you're answering these questions, you answer them in level. Level 1, you are supposed to calculate the ratio. Level 1, you're supposed to show the basic information about financial statements. Then level 2, you're supposed to do calculation. Level 3, you're supposed to give recommendation justifying your answer as per your calculation. So we move on to another aspect that we are going to cover in our next presentation. For the meantime, I think we say bye-bye. We wish you all the best in your examination. Remember, hard work pays. Okay, hard work pays. If you work hard, you'll see everything changing, your results changing, your performance improving. Above all, we pray. We believe that with God, all things are possible. With God, all things are possible.